What does an economic collapse truly look like, and why do mainstream analysts and economists often fail to see the disaster that some predict?
2024 is going to bring, and I'm quoting him now, the biggest crash of our lifetime.
Economic firestorm is just beginning to gather force.
As we navigate through uncertain economic times, the looming question on everyone's mind, it is, what could trigger the next economic crash? The global economy is a complex system influenced by numerous factors, and understanding potential triggers is essential for preparedness and mitigation. In 2024, this question has become even more pressing.
It's a move that has the potential to disrupt supply chains around the world.
The world is still grappling with the aftershocks of the COVID-19 pandemic, which disrupted global supply chains, led to unprecedented government spending, and caused significant shifts in consumer behavior. Additionally, geopolitical tensions are at an all-time high, with conflicts and trade disputes threatening economic stability. Climate change is causing more frequent and severe natural disasters, impacting economies worldwide. The rise of automation and technological disruptions is reshaping job markets, and cybersecurity threats are becoming more sophisticated, posing risks to financial systems and critical infrastructure. Meanwhile, financial markets are showing signs of instability, with high levels of corporate and government debt, inflated asset prices, and the potential for financial bubbles. Given these factors, it's crucial for individuals, businesses, and policymakers to understand the potential triggers of an economic crash. By being aware of these triggers and recognizing the stages of denial, we can better prepare for the challenges ahead, make informed decisions, and take proactive steps to protect our financial well-being. Recently, we came across a thought-provoking article by Brandon Smith from alt-market.us on Zero Hedge, which addresses the 5 stages of denial that people experience when confronted with an economic collapse. This article offers a comprehensive analysis of the denial stages and provides valuable insights into why many remain oblivious to the warning signs of an impending economic downturn. In this discussion, we will explore these stages in detail, illustrate them with real-world examples, and discuss their implications for individuals and society at large. By recognizing these stages and understanding the underlying factors that could trigger the next economic collapse, we can better prepare ourselves and take proactive steps to safeguard our financial future. Understanding economic collapse. An economic collapse is not a sudden event, it is a gradual process. Many imagine it as a rapid catastrophe, similar to the 1929 stock market crash that led to the Great Depression. However, numerous warning signs preceded that crash, which were largely ignored. This tendency to overlook indicators continues post-crash, with mainstream experts often proclaiming imminent recovery, despite evidence to the contrary. They prefer to maintain the illusion of normalcy, even when the economic signals suggest otherwise. Stage 1. Denial. Everything seems fine to us. The first stage of denial involves people insisting that there are no problems because their personal circumstances are stable. If someone is not experiencing financial difficulties, they are less likely to acknowledge broader economic issues. This mindset is prevalent today, with generational conflicts where younger people blame older generations for economic problems, and older individuals accuse the young of being too negative. The reality is that the younger generation has faced tougher economic conditions and less time to build financial security. Consider the housing market. Many older homeowners who bought properties decades ago at significantly lower prices may feel secure and dismiss warnings of a housing bubble. Meanwhile, younger generations struggle with skyrocketing home prices and stagnant wages, making it nearly impossible for them to afford a home. This gap in perspectives creates a disconnect in understanding the broader economic issues at play. Older generations might remember times when mortgage rates were higher but property prices were lower, making homeownership more attainable even with higher interest rates. They might also have benefited from steady job markets and wage growth, which are not as prevalent for younger generations today. This disparity leads to a failure to recognize the current economic strains and the potential risks of an overheated housing market. Stage 2. Skepticism. We heard this before. In this stage, people dismiss warnings about an economic collapse because previous predictions did not materialize as expected. They remember dramatic images of past crises, like soup lines and stock market crashes, but fail to recognize that these are outcomes of prolonged economic decline, not its onset. Significant economic changes, such as those following the 2008 financial crisis, unfold gradually. For example, excessive government spending has eroded over 20% of our purchasing power in the past 5 years. The signs of collapse are present, but they manifest slowly. The dot-com bubble in the late 1990s serves as a reminder. Initially, skepticism was high as the tech sector boomed. People ignored the warning signs of overvaluation and rampant speculation, leading to a massive market correction that wiped out trillions of dollars in value. This skepticism often stems from a misunderstanding of the nature of economic cycles and the complexities of financial systems. People tend to expect immediate and dramatic consequences following any economic warning. When these don't materialize quickly, they dismiss the warnings as false alarms. For example, during the housing bubble before the 2008 crash, many analysts and commentators warned about unsustainable lending practices and overvalued property markets. However, because the collapse did not happen immediately, these warnings were largely ignored. Impact of denial and skepticism on policy and personal decisions. Denial and skepticism not only affect individual perceptions, but also influence policy decisions and personal financial strategies. Policymakers who downplay economic risks may delay necessary interventions, such as tightening financial regulations or addressing public debt levels. This can exacerbate economic vulnerabilities and lead to more severe consequences when a downturn occurs. For individuals, denial and skepticism can result in poor financial planning. Those who believe the economy is stable may avoid diversifying their investments or fail to build emergency savings. When economic conditions worsen, they find themselves unprepared, facing significant financial hardship. Stage 3. Minimization. This crisis is temporary. As instability becomes undeniable, skeptics start to admit that there might be a problem but convince themselves it's only temporary. This stage involves a coping mechanism to avoid facing harsh realities. They cling to the hope of a soft landing, despite mounting evidence that the crisis is not transient. This stage is marked by an unwillingness to acknowledge the full extent of the economic downturn. During the initial stages of the COVID-19 pandemic, many believed the economic impact would be short-lived, expecting a rapid recovery as seen in previous recessions. However, the prolonged effects on various sectors, especially travel and hospitality, highlighted that the crisis was far from temporary. Stage 4. Blame. No one could have predicted this. When the crisis becomes too evident to ignore, the narrative shifts to "no one saw this coming." This stage often involves deflecting responsibility despite numerous warning signs. Media and establishment figures who previously downplayed concerns now claim the crisis was unforeseeable. This denial stems from an unwillingness to admit they ignored clear indicators and the voices of those who warned about the impending collapse. During the 2008 financial crisis, many financial experts and media outlets claimed that the housing market collapse and subsequent economic downturn were unpredictable. In reality, several economists and analysts had raised alarms about subprime mortgages and the housing bubble years before the crash. Stage 5. Acceptance. We knew it all along. In the final stage, as the collapse becomes undeniable, people claim they always knew it was coming. Admitting otherwise would validate the warnings of so-called conspiracy theorists. This stage is about preserving one's self-image and avoiding the uncomfortable truth that they could have prepared but chose not to. It's easier to believe they were aware all along than to confront the reality of their inaction. After the Great Recession, many financial analysts and pundits shifted their stance, asserting they had seen the signs of economic trouble all along. This revisionist approach helps them maintain credibility while avoiding accountability for not acting on earlier warnings. Impact on society. Understanding these stages is crucial for navigating an economic collapse. It helps explain why so many people are unprepared and why denial is a common reaction. Mainstream narratives often downplay or dismiss warning signs, leading to a false sense of security. Recognizing the signs and stages of denial can empower individuals to take proactive steps to protect themselves. Awareness and education are key to preparedness. By sharing knowledge and insights about economic indicators and potential crises, we can help more people recognize the signs and take necessary actions. If you're seeing the warning signs and want to protect yourself, consider diversifying your investments and seeking advice from financial experts. Tangible assets like gold and silver can provide stability in uncertain times. During times of economic uncertainty, investments in tangible assets such as real estate, precious metals, and other commodities can act as a hedge against inflation and market volatility. Diversifying your portfolio with a mix of stocks, bonds, and alternative investments can also help mitigate risks. The economic collapse is a process marked by denial and gradual realization. By understanding and acknowledging the stages of denial, we can better prepare for what's to come. It's important to stay informed, take action, and share this information with others to ensure that more people are ready for potential economic challenges.